All right, we are going to get started. Hello, everybody. Hope you're having a great day. My name is Terry Parham, one of the founders of Innovative Wealth Building and one of the advisors here on our team. In addition to myself, you probably know Jennifer, Warren, Kenna. We're the four owners of Innovative Wealth Building, other partners and teammates in the office. Regardless of who told you about the event, so happy for you to join me tonight. We're going to talk about a topic that's near and dear to my heart, and that is taxes. I recognize that liking taxes probably makes me a little bit weird, but I think that's part of why I was elected to give today's presentation. So I always look to do a sanity check before I get started, just to make sure it's not just me talking to me. So if someone has access to the chat box, please just let me know that you can hear me if it's loud and clear. If it's too loud, let me know. I'll talk a little bit more quiet. But if someone could just give me a thumbs up, perfect. Thank you, Heidi. Thank you, Don. Troy, appreciate it. So thank you so much. We're going to get ready to get started. So as I mentioned, the topic today is tax preparation for individuals, families, and business owners. Next month, we're going to do a deeper dive for business owners in particular. Today, we'll touch on some things for business owners, but in general, these will be important points of knowledge and planning strategies for pretty much anyone. Now, there's a big difference between tax filing and prep and tax planning. Today, I'm going to give you some insight that's going to really help with the planning and just knowledge to help you feel more armed as you go into tax season, to make sure you get the most out of it, and to maybe even give you some good questions to ask as you work with your accountant, your CPA, or with yourself to take care of your taxes for 2024 and beyond. As usual, we have our disclaimer. Although I do have advanced certifications and knowledge in taxes and tax, I am not an accountant. Today is meant to be educational. We're going to talk about many things, but please don't take it as a direct recommendation. Chat with your advisor to see if these things that I mentioned are in your best interest. And of course, talk to your trusted accountant or other financial professionals in the tax field, estate planning. We'll touch on a little bit of everything today, but just our big caveat is this is meant to be educational and of course not a direct recommendation, because I'm talking to lots of people at once versus just one-on-one. So here's our agenda. We're going to cover some tax basics. We'll give you some knowledge. We'll talk about planning opportunities, and then we'll summarize and talk about next steps. And really, the next steps are upon us because tax season is officially off and running. So without further ado, we'll jump right in. I used this same graphic last time. And in general, when I ask people how they feel about taxes, it's usually a thumbs down. Tax time can be really stressful. It's complicated. There's like 7,000 pages in the tax code. But unfortunately, taxes are a way of life. And for many of us, it ends up being one of our biggest expenses in retirement. So we really want to understand how taxes work so that we can plan for them and make the most of our situation. We'll talk about why taxes matter, again, knowledge and strategies, and then we're going to look forward at how you can do some proactive planning. Leading up to this presentation, you may have received a few different resources. If not, we'll make this available to you. We have a few different resources related to tax prep and also how you can review your tax return if you're still working or retired. This is just a glimpse at one of the checklists that we provide to help our clients with just filing and getting prepared for taxes. So if you haven't seen this or you didn't receive it already, just say in the chat, hey, we didn't see it, and then we'll make sure that we send it to all of our attendees at the conclusion of today's presentation. So some of the common pitfalls that we want to help you avoid is failing to plan. We know that there's so many things to know that it's impossible for us to know it all, so we're going to give you some knowledge today. We want to make sure you know that it's important not to miss deadlines because deadlines can lead to penalties and assessments. If you're a business owner, the biggest mistake I see is business owners having personal and business assets commingled. So we'll talk about why you don't want to do that. And then lastly, underpaying or overpaying your taxes by a big amount is not a good thing. By getting a big tax refund, that means you gave a big tax-free loan to Uncle Sam. And again, if you underpay your taxes, you might have a penalty, and they charge interest. So we want to hit that happy medium of where we get the most bang for our buck with taxes. So thank you for saying that you all did not receive that. We have a newsletter and all sorts of other resources where we provide those links. I'm going to pop it in the chat. So the tax prep checklist that I previewed, I just put it in the chat. You should be able to just click and download. But yeah, please enjoy. It's one of the many resources we have to help with taxes. So we may have even more that we can share with you as we get through today's presentation. So we're going to get started with income. When I think about taxes, the first step is understanding income, and then there's a bunch of deductions, and then there's credits, and then there's the bottom line. What do you owe in taxes? So let's start with income. In general, income is all the money that you make. This could be earned income from W-2, 1099, K-1, etc. This could be income from your investments. This could be payouts from Social Security, from retirement, from a pension. Income is pretty much everything. For some purposes, tax-free income actually counts as income. So again, there's many types of income. I'll show you an example in a minute, but income is just all the money that comes in. Hopefully it's not too many sources, but it counts everything. Tax brackets. Tax brackets are not super easy and simple. They're called progressive. So as you make more money, the tax brackets go up. They also work like a stair step. The first bit of your money's taxed at a low rate, and then the rate goes up, and it goes up, and it goes up. So as you make more money, the taxes are higher in general, but there's little stair steps, and each pot of your money pays a different tax bracket as you go up the amount of income. So I'll show you an example about that in a minute. Deductions. Bottom line, there's above the line deductions, there's below the line deductions. People often say, well, what the heck is the line? Well, the line is AGI, which is adjusted gross income. And people say, well, what the heck is adjusted gross income? Don't worry, we'll talk about what that is in just a moment. Lastly, credits. A credit is a one-for-one offset of the money you owe in taxes. So that's in the example that I'll show you. Again, these things break down to be the big pieces of figuring out how much you owe in taxes. So again, it's just knowing your income, seeing how the tax brackets work, taking deductions, applying credits, boom, that's how much you owe. So here's a calculation. I'm a bit of a math nerd, so I try to make this really straightforward. After this slide, please let me know if it's not straightforward. If it's not, I have to delete the whole presentation and start over. So let's say that you have $100,000 of gross income. So you're a person that has $100,000 of total income. Doesn't matter the source. That's our starting point, 100,000 of gross income. And gross just means before taxes. If during the year you put $10,000 to your 401k, and then you put $5,000 to a health savings account, those things both get deducted from your gross income. So if you just take how much money you make total, like your salary, 100,000, and you subtract out the 401k and the HSA, those are called above the line deductions. Not only do they reduce your taxable income, but they also reduce how much you pay in Social Security and Medicare taxes or other things. There's other types of above the line deductions, but just know we go from gross income, which is the biggest number, we subtract above the line deductions, and then we get to our adjusted gross income, also known as our AGI. This is the most important number on your tax return. AGI is often what drives other parts of your life, be that Medicare premiums, taxability of Social Security, if you can put money into a Roth IRA, almost everything comes back to AGI. Now, there's something called MAGI, modified adjusted gross income. We're not going to go into it, but it's basically AGI with a couple things added back into it. So we started with the big number, we subtracted out some common things, and we're at our adjusted gross income. A lot of people think you get taxed on this number, but that's incorrect. At this point, you can take the standard deduction. The standard deduction is an amount of money we all get to not pay taxes on that's set by the government. So if you're single, married, head of household, everyone gets this different number. We either subtract this number or you itemize, meaning you add up a bunch of things. And once you do the math, we now end up with your taxable income. Taxable income is what you actually get taxed on. This seems simple, but it's kind of confusing and people sometimes don't realize that. They think that because they make $100,000, they get taxed for federal purposes on 100,000. That's simply not true. You take your gross income, subtract the above the line deductions, then you apply the standard deduction or the itemized below the line deductions, and then you get to your taxable income, which is what you actually get taxed on. From there, we apply the stair step. So some of your income's taxed at this percentage, then that percentage, and then that percentage, and then it adds up to a total. I wanted to make this super, super simple. So if we take our 70,000 of taxable income, and let's just say half is taxed at 10% and half is taxed at 20%, that works out to us owing $10,500 in taxes. Now, these aren't the real tax brackets, but I wanted to use really simple numbers so we get clean math. But truly, that's how it works. There's little chunks of income taxed at different percentages, and then we get a total amount you owe in taxes. Last but not least, there are credits. There's credits for energy efficient things in your home. There's credits for having children. There's the earned income credit. There's the American Opportunity Tax Credit for education. Any credit you have is a dollar for dollar reduction in your tax bill. I just made up a scenario where a person has 2 kids. Each kid gets a $2,000 tax credit for the parent. Voila, your total tax bill is $6,500 in this imaginary scenario. Again, this is just meant to show you the overall flow of how it works. We start with your gross income, we subtract out the deductions, we do a little bit of math to get your tentative tax liability, we apply the credits, and then magically, this is how much you really owe. If you go through your tax return, you'll see all of these fancy things in there. Unfortunately, there's about another 100 line items, but I just wanted to show you kind of the summary before we dig into some other topics. So that was just a quick introduction to taxes. Hopefully that helps a little bit. I know it's one of those things I certainly wasn't taught in school. I do want to just invite you, if you have any questions or comments as we go along, please put it in the chat box. I'm open to all questions and comments, so even if you want to just put a thumbs down, that's okay. I've probably been told worse, but we'll keep on rolling. So let's talk for a minute about investment income. If you have investments, you may already know about how investment income works. Now, retirement accounts are not what I'm talking about here. I'm more so talking about non-retirement assets where you get a 1099 every year or some years. 1099 is just a form of income that you receive. When it comes from your investments, it's usually a 1099 DIV for dividends or a 1099 INT for interest. But overall, it breaks down to capital gains, dividends, and interest. To make it super simple, capital gains is when you buy something for $1, it grows to $2, and then you sell it. You have a capital gain of $1 in that instance. A dividend is when you own something and it pays you dividends. So Terry buys a stock for $100, it pays a $1 per year dividend. I pay taxes on that dividend. Interest is just like your bank account. You put $1 million in the bank, they give you $500 of interest. There you go. That's how interest works. Each of these items has slightly different tax rules. For capital gains, if you buy something and sell it in a year or less, you pay ordinary income taxes. But if you buy something and hold it for a year and 1 day or longer, then you pay capital gains rates, which could be as low as 0% and as high as 23.8%, depending on your income. For most Americans, it works out to 15%. And for some people, again, it's 0%. For dividends, these can be either qualified or non-qualified. Non-qualified dividends are taxed as ordinary income. Qualified dividends, again, taxed at 15% like capital gains. Lastly, interest is typically taxed at ordinary income. So that money you earn in your bank account, again, if you have a nice bank account paying 4 or 5% interest, that is fully taxable, almost to the same degree of income that you earn at work or income that you earn through a pension. So overall, these are the 3 ways that investment income gets paid out. Again, this is not related to retirement accounts. This is often related to taxable investments. Heidi, thank you very much for letting me know that it seems straightforward. I have a problem with sometimes going way too far in the weeds, so I'm going to try my best to stay up here. So thank you very much. Okay, so overall, that's how investment income works. Later, we'll talk about some of the tax planning strategies that if you've never heard of, that could be really helpful for your situation going forward. With filing, you're going to have one of potentially several statuses. Single, that's pretty straightforward. There's head of household. There's surviving widow or widower. There's married filing joint and married filing separate. Just to put this out there, if you're married, more often than not, married filing joint is the best way to file your taxes. In limited scenarios, married filing separate is optimal, but for 90% of the cases out there, maybe more than 90%, married filing joint is actually the best one to use. When you file married and separate, especially in retirement, there are some really nasty tax rules out there that penalize you for making an election. So again, just to put that out there, if you're married, filing joint, MFJ, not MJF, is typically the best thing you can do. In certain cases, married filing separate can be better. If you don't know, ask your accountant to run it both ways and see how it works for your situation. Often, we have minor children that are making money, and parents will say, hey, what do I do with this income? So a week or two ago, one of our clients sent us an email and says, hey, my son made $8,000 at work. Does he have to file a tax return? Oh, by the way, do I need to claim his income on my tax return? Couple short answers. Answer number one, no. If your child makes income, you do not need to claim it on your tax return. Your tax return is just your income, be that single or married folks. Question number two, does your child need to file a tax return? The answer is no. There's a minimum amount of money you can make to not have to file a tax return. So basically, if you make around $13,000 as a single person, you don't have to file a tax return because you're below the de minimis amount. The caveat to that is if you had federal taxes or state taxes withheld, you do have to file a tax return in order to get that money sent back to you. But if you're a child or you know that your child is working and they're going to fall below that 13,000, you can actually have them change their withholding so they pay nothing in federal and state taxes. They'll just pay into Medicare and Social Security. They never have to file a tax return and they keep as much money as humanly possible. So again, when kids are making money, that money from your kids does not go on your tax return, and they probably don't have to file a tax return, although they might get money back if they do file one. Another question is, if my kid files a tax return, can I still claim them as a dependent? The answer is yes. Them filing a return has nothing to do with if you can claim them, as long as you still meet the IRS definition of providing enough support for them, which is financial, and typically that means they live with you as well. Quick thing about education planning, there's a ton of different accounts you can use for education planning. 529s, Coverdell's, UTMA, UGMA accounts. That's often a big thing for parents. When it comes to taxes, just be aware how 529 distributions work and how they impact things like FAFSA, if you're in the process of getting student loans or anything like that. All these little accounts have a big meaning when it comes to both income and then also assets available. So if you have a child that's in college, think about how you use those education assets, because the amount you're taking from those assets and your school expenses may have an impact on your ability to take the American Opportunity Tax Credit, the Lifelong Learner Tax Credit, and other things. So again, the big picture, if you have a kid or yourself doing some education, make sure that's a conversation between you and your accountant at tax time. All right, I'm going to guess that I have some business owners in the crowd. So true or false? Starting an LLC saves you money in taxes. I'm going to look at the chat box and hope someone's brave enough to answer this. Jen, you can answer it if you like. But the question is true or false? Starting an LLC saves you money in taxes. So I'll wait for a moment and see if anybody is willing to take that one on. There's a 50-50 shot you'll get it right, even if you don't know. So Heidi says no. Does anybody think yes, starting an LLC will save you taxes? All right, well, Heidi is correct. Filing an LLC does absolutely nothing for you tax-wise. In most situations, a person filing for an LLC is a sole proprietor. That means they are the only person working in their business. So all the money they make flows through to their personal tax return. Now, if they file an LLC, it doesn't matter. It's called a disregarded entity, so all the money still hits their bank account. Well, Terry, what if I start a business with a friend? Well, that's called a partnership. That is also a disregarded entity. So if you file an LLC, even with more than one person, all the income gets split and then it still flows through to your personal tax return. So then what do I do if I want to take my business income and optimize it so that I don't get taxed on the whole thing? Well, that comes down to business structuring. And I have a quick blurb about that in just a little bit when we talk about business owners. So I think that's on our next slide. Choosing the right structure is really important. If you're a business owner and you're making, let's just say, less than $100,000, being a sole proprietor or a partnership is probably fine. But if you're making well into the 100,000 plus, you may want to consider your options. The bottom line is if you're a sole proprietor or partnership, aka a 1099 person, 100% of your net profit is subject to self-employment tax. That's basically a 15.3% tax on all of your profit from your business. Maybe you don't want to pay 15% on all of your profit. So what some business owners will do is they will create an S Corp or a C Corp that pays them a W-2 salary, and then they take the rest of their profit as a profit distribution. Profit distributions escape self-employment tax, Medicare, and Social Security tax. So again, if you're a business owner and you're 1099 fully and you're making hundreds of thousands of dollars, you need to call your accountant tomorrow and look into potentially reclassifying as an S corporation. S corporations are the most popular type of business entity for businesses that are earning good income. C corporations can sometimes make sense. They typically do not unless you're doing some fancy stuff. So again, 1099 business owner making lots of money, you probably should consider an S corp. Talk to your accountant. 1 out of every 25 will probably need to do a C corp instead. A C corp, bottom line, is subject to double taxation. So that's the big downside to a C corp. But big companies like Amazon, Apple, those are C corps. So if your company is like an Amazon or an Apple, or you plan to be one, maybe you should be a C corp. But again, as your income goes up as a business owner, you do want to make sure you have the right structure. Now, if you're a W-2 employee or a normal employee like most folks, when you make your paycheck, taxes are automatically taken out. As a business owner, that often does not happen. And if you don't pay quarterly tax estimates, you can have a big fat penalty at the end of the year. So again, broadly, every quarter, the dates are published on Google. You need to make a payment to the IRS. It should be hopefully close to what you actually owe because they don't give you any interest for paying them too much. But the lack of paying estimated taxes leads to big penalties. And if you've combed through your tax return for prior years, you'll see it. It's a line item that says how much you paid in penalties and interest for underpayment. How does business income work? Bottom line, your revenue is all the money you make from doing your business. You subtract out all the expenses, and then what you're left with is the net profit. That's the only portion that's taxable. Before you even get to net profit, there's big deductions for business vehicles, health insurance, 100 other things, including QBI, qualified business income deduction, which is a reduction of 20% of your business income. Again, this is meant to just be super short for business owners because often people have 1099 income in addition to their regular income. Next month, the whole webinar is about business tax planning strategies. So if you're a business owner, you may want to tune in for next month's presentation. For high income earners, ideally you want to reduce your income, but often that's easier said than done. Deferring income can sometimes be possible, pushing it to future years. Paying tax in 2026 is always better than paying in 2025, but there are limitations to how we can do that. If you want to itemize, deduction bundling could be a great idea. So a real life example is someone who likes to give money to different organizations. Instead of giving small amounts every year where maybe you're not able to deduct it, consider giving a big amount one time that you disperse over the course of time as a way to take a deduction on your taxes, but also still give to the charities or to the things you find purpose in. There are tax preferred accounts you can use to reduce your income: 401ks, 403bs, TSPs, HSAs, with their health savings accounts. There's a bunch of other things you can do to reduce your income. But overall, you just want to look at your situation and consider the things that are in alignment with your goals to not only save money in taxes, but to help you build wealth over time. Donations are often in the way of cash or non-cash donations. For many people, you can actually, if you itemize your taxes, you can take a non-cash donation of $5,000 or so from just things that you take to Goodwill, Salvation Army, etc. Now, if it's under $5,000 or so, you don't need to have your items appraised. You can just get a little receipt from where you donated that says that you had non-cash donations, and you can get a nice tax deduction. If you gave cash donations to 501c3 charities, typically they'll send you a receipt in the mail. If you know you gave cash, but you didn't get a receipt, you may want to reach out to that organization so they can send you proof that you can then use when you file your taxes. If you don't have the evidence, you could still take the deduction. Just know there's a potential risk if you get audited that that deduction would be disallowed, and then you would owe money on the taxes and also potentially a penalty. We'll talk about a few different tax strategies now. So earlier we talked about dividends, capital gains, interest. There's a strategy called tax loss harvesting. Right now it's a little bit late for 2024, but for 2025, this is something you could consider. Tax loss harvesting is basically selling investments at a loss in order to save yourself money in taxes. So let's say you went crazy and you bought Bitcoin, and let's say you bought it 2 weeks ago for $100,000. And now Bitcoin fell to $97,000 in your portfolio. You can sell the Bitcoin. That's a $3,000 loss. And at tax time, you can take that $3,000, reduce your earnings, and then reduce your taxes. Now, if you really want to be fancy, once you sell at a loss, you can rebuy the same asset. And then if it goes up, you can enjoy the growth. Things like Bitcoin are not real securities in the way your investments are. So there's no such thing as the wash sale rules. But if you do tax loss harvesting with money at Schwab or money at T. Rowe Price or Vanguard, just know you have to wait 31 days before you rebuy the exact same investment so that you are able to harvest the tax loss, but not have to recapture the loss. Again, it's called the wash sale rule. So just be careful with that. A lesser known strategy is called tax gain harvesting. Big picture, if you're married and your total income is under around $98,000, you could actually be in the 0% capital gains bracket. What that means is if you buy a stock, say at $10,000, and it goes up to $20,000, you can sell it and pay $0 on the $10,000 gain. Again, this is called tax gain harvesting in the 0% tax bracket. This is a great strategy if you're going to have total income below the phase out amount, which again is around $98,000 for the 0%. So that's one of those things as you're going through the tax year to be aware of your total income. Because if you make some quick gains, you might be able to sell it, lock in the gain, pay no taxes at tax time, and then reinvest the money for continued growth into the future. As you look at your portfolio or as you review your tax return, you might see dividends, interest, things of that nature. If you're in a situation where you want to pay less in taxes, it might be time to restructure your portfolio. Maybe there's more tax efficient investments. Maybe there's tax exempt investments. Maybe you take some of your taxable money and you put it into a different vehicle that will shield the taxes for the rest of your life while still growing your wealth. There's lots of choices out there. So you just have to be tuned in to what your pain points are. If you're paying too much in taxes and you don't like it, there are, I don't want to say 100 different things, but there's many different things that you could do to alleviate that pain and have a more tax efficient way to build wealth. Roth conversions are simply taking money that's going to be taxed later and converting it to money that will be taxed never. It's basically taking pre-tax money, paying the tax today, and then letting it grow tax-free for the rest of your life. You can spend it and enjoy it yourself, or you can leave it to your beneficiaries tax-free. Roth conversions are a great way to diversify your wealth and also to leave a tax-free benefit to those you care about. The last couple things are charitable in nature. QCDs are qualified charitable distributions. Think of it as you taking money out that you have to take out anyways, but then being able to give it to charity instead of paying taxes on it. So that can be helpful for people over age 72 or 73 that are taking required minimum distributions. Donor advised funds if you're charitably inclined, can allow you to take a $100,000 tax deduction this year, and then you can give out the money for the next 20 years if you want in bite-sized chunks. So again, there's lots of ways you can reduce your taxes this year, next year, or for the next 20 years. Just depends on your situation and what you want to accomplish. But this is just to introduce you to some of the potential strategies that you could be utilizing if you haven't heard of them before. Again, if you have any questions, comments, please let me know. I'll be periodically checking the chat box. I'm glad I took a look because there was a question. So there was a question about annuities. When are annuities taxed? Only on dispersal. What form do they use? Great question. Annuities are typically tax deferred. So just like a 401k, the money that's in the annuity grows and it grows and it grows and it grows. And you're correct, there's no taxes until you take the money out. Depending on the type of annuity, the whole amount you take out could be taxed, a proportion or a percentage of it could be taxed, but that really depends on the type of annuity that you use. Again, depending on the type of annuity, it could be a 1099-R or it could be a different type of tax document. In general, tax documents are 1099s of some sort, INTs, DIVs, or 1099-R. In most cases, it turns out to be a 1099-R because annuities are often in retirement accounts. So great question. Yeah, QCD. A QCD is a qualified charitable distribution. I think later we're going to talk about RMDs. I said I think because I had so much content, I had to cut some out. So when you're over a magic age, the IRS says you have to take out a certain amount of money. So let's say you're over 75 and the IRS says you have to take out $20,000. Well, if you take out $20,000, you have to pay taxes on that $20,000. However, if you use a QCD, a qualified charitable distribution, you take out that $20,000 to fulfill your required distribution, you give it to a public charity, that $20,000 goes to a good place and you don't have to pay taxes on it. So anytime you're going to give money to charity, I would encourage you to do it in a way that's tax efficient. Last year, I decided to give money to charity. Instead of giving cash, which I do give, I gave them some stock that I bought. I bought Coinbase. It quadrupled during the year. So I gave my Coinbase stock. So I was able to give away, say, $10,000 of benefit to a charity, which is tax-free to them. And it only cost me $2,500. So again, the QCD, qualified charitable distribution, it's a way you can give away money and avoid paying taxes on it when you take it as a distribution from your IRA, your 401k, or other pre-tax money. So, Ronald, thank you for the question. Hopefully that makes sense. Great questions. Please keep them coming. A few reminders just about taxes. If you haven't filed your tax return yet, you still have time to do your 2024 contributions. So if you had earned income, you can still do your IRA or your Roth IRA contributions. That can be a deductible IRA. That can be a non-deductible IRA. That can be a backdoor Roth. It can be anything. People often tell me, well, I make too much money. I can't do Roth at all. That is 100% incorrect. No matter how much money you make, you can't do the backdoor Roth. You may have to pay a little bit in taxes, but depending on your situation, you might be able to do it tax-free regardless of your income, even if you're Bill Gates. I mentioned required minimum distributions earlier. If you're over the magic age, you may already know that you're taking money out. If 2025 is your first year taking distributions, you either have until April or the end of the year to take the distribution. If it's your first year and you wait until April to take it, just know the first year you have to take distributions twice, which kind of stinks. So make sure you're planning for that and just timing your distributions the way that works the best for you. One aside for taxes, when you're taking required minimum distributions, they have the first dollar rules. The RMDs come out first. So I mentioned Roth conversions earlier. Just know that if you're RMD age, you cannot do a Roth conversion until you take out your RMD. Then you can do a Roth conversion. I said earlier, the tax code is like 7,000 pages long. It is absolutely overwhelming. So if you're doing any of the strategies, talk to your advisor, talk to your accountant or tax professional to make sure that you do it correctly and don't run into any IRS issues. Last thing is if you did a rollover, you often will get a 1099-R in the mail. A rollover is when you take money from TSP or 401k and move it to a personal IRA. Sometimes the rollover, there's no taxes whatsoever. Sometimes it is taxable. More often than not, it is not taxed if you do a qualified rollover to a place like Schwab or a custodian. Don't accidentally pay taxes that you don't owe. So if you're doing your own tax return, please be careful with that. But if you're working with an accountant or a professional tax preparer, they're very proficient at that. That's typically something that they wouldn't make a mistake on. There's a question from Troy. Can you still claim charitable contributions until tax day, or is December 31st the tax cutoff? That's a good question. The charitable contribution really should have happened during, the prior tax year. Sometimes you can do it after the fact, especially if you did non-cash donations that happened last year. You were just a little late getting the documentation, or you got the documentation after the fact. So talk to your accountant to see how they can handle that for you. Even as a business, sometimes things show up in 2025. You can recharacterize it to 2024, and that's perfectly valid in your books, depending on how you're keeping your books. So talk to your accountant, but that could be a possibility. RMD for multiple IRAs, can you take it from a single source? Yes. If you have 10 individual retirement accounts, you can aggregate them all together and take one RMD distribution from one account as long as you take enough money. Important to know, if you have a 401k and an IRA, those are different. You have to take an RMD from the 401k and the IRA. If you have 5 401ks, you have to take an RMD from each 401k separately that has been calculated separately. If you have 5 403bs, they aggregate together like IRAs. It makes no sense, but that's how the tax code works. Great question. And what is the age where RMDs kick in? It used to be 70 and a half, then they moved it to 72, then they moved it to 73. The bottom line is if you were born after 1960, so January 1st, 1960, age 75 is the magic age where you start taking RMDs. If you were born, let's say, between 1950 and 1959, age 73 is the magic age for you. In the 40s and beyond, it's 72 or earlier. Great question. Again, they can't make anything simple, but now if you're after 1960, it's 75, and we'll see how long that lasts until they change it again. Yeah, great questions. I'm glad I studied this today before the presentation, or else I would have been in a lot of trouble. You guys are smart. So we'll speed on through. We'll talk about health savings accounts. And I'm looking at the time. I've got about 15 minutes. Unfortunately, I didn't number my slides, so we're going to find out together how many slides I have today. If you have the ability to use a health savings account, I would say it's the best tax tool that exists. Health savings accounts are triple tax advantaged, meaning they're tax deductible when you put money in. The money grows tax deferred, and you can take the money out tax free for qualified expenses. What some people don't know is when you have money in a health savings account, you can invest it in the stock market and let it grow. Even better than that is you can put money in and take it out later tax free and spend it on a boat if you want to. So how does this work in the real world? Let's say you put $40,000 into your HSA as contributions over time. You invest it and it grows to $100,000. And let's say that over your working history, you pay out of pocket for a bunch of medical expenses. What you're able to do is any medical expenses in your lifetime that you paid for out of pocket that were unreimbursed, you can take that money out of your HSA completely tax-free. So in my example, you put in $40,000, it grew to $100,000. Let's say you had $40,000 of medical expenses over your lifetime. You can take the $40,000 out tax-free, buy a boat, a cheap one probably, and then leave the $60,000 to spend tax-free on medical expenses, and life's good. You absolutely can do that. So that's one of the little known things that people miss out on. Your health savings account money can get invested, it can grow. You can pay your medical expenses out of pocket with cash and then reimburse yourself for a lifetime of expenses completely tax and income tax free. Now, you do have to have some semblance of records of the money that you paid in unreimbursed expenses, but it's a pretty cool workaround to use that money for a different purpose. Oh, by the way, if you're over 65, spend the HSA on whatever you want. There's no penalty. You will pay taxes if you buy a boat with it, but just know that after 65, you can use that money for any purpose. There's a question, does long-term care insurance count as an HSA? Does long-term care insurance count as an HSA? If the question is, can you pay your premiums from an HSA? I believe the answer is no for that. Unfortunately, the HSAs don't really let you pay for premiums typically. However, some long-term care premiums are tax deductible, and the list of qualified expenses for HSA purposes is really, really, really long. So if you haven't seen that list and you want it, put it in the chat and we can make sure we send it to you. There's a long list of things that qualify for HSA qualified expenses where you can use the money tax-free. I was surprised by how long the list was. So great questions. And an FSA, I put that on the screen. That's a flexible spending account. Often that's used for healthcare of some sort. It's not as good as the HSA because they have use it or lose it provisions. So in general, if you can pick between an HSA and an FSA, net, the HSA is going to be a better deal. But sometimes employers will give you money in the FSA. If you have those options, chat with your advisor and find out what's best for your particular situation. Life insurance distributions. We'll hit this one pretty quick. Most people probably know if you unfortunately have someone pass away and you receive a life insurance death benefit, it's typically tax-free. There's some situations where the money could be taxable, but that's the exception, not the rule. So I'll just say in general, the death benefit is most often tax-free. Now, if you have a life insurance policy with a cash value and you take a loan from your cash value, the policy loan is tax-free income that you can use however you want. If you don't pay the loan back, it could count as income. But just know when you take a policy loan, or any loan for that matter, it doesn't count as income. And that's one of the dirty secrets of how the wealthy spend money and never pay taxes. They take loans, and then with certain loans, you can let your asset continue to grow and not pay the loan back or pay it back really slowly. Lastly, with life insurance, if you cash out a policy and get back a big old cash value, some of the money you get back is tax-free. The rest of it would be taxed as ordinary income. So just know if you have cashed out a life insurance policy or you plan to do it in the future, depending on how long you had it and how it grew, there's a very high likelihood you could be subject to some taxation if and when that situation does occur. Real estate is a big thing that happens often. Last year, I think home sales slowed down, but typically if you sell a home, there will be taxes unless you qualify for the capital gain exclusion. Bottom line, if you lived in the home as your primary residence and it was occupied by you for the majority of the last 5 years, a single person can reduce their profit from selling a home by $250,000. Married folks can use a $500,000 exemption. So basically you sell your house for less than $500,000 if you're married. Excuse me, the profit's less than $500,000 if you're married. You walk away, you pay no taxes. For single folks, again, it's $250,000 of net profit. Before profit, you get to add in improvements, fees to sell the house, closing cost. Most people sell homes and walk away without paying anything unless their house really went up in value over the course of many, many years. With rental property, this is a funny one. Some people have rental property and it's just tax-free income. Technically, you should be paying taxes on it. Will it matter? Maybe not if you don't ever get audited, but just know if you're receiving rental income and you're not claiming it as income and paying taxes, if I were you, I wouldn't be taking deductions related to the rental property. So just be careful there. If the IRS sees that you're taking rental property deductions, but you're not showing any rental property income, that could be a big waving red flag. And in our industry, we don't want any waving red flags. So just be careful with how you utilize rental properties. Last thing on real estate, let's say you own real estate and you want to sell one property and buy another, but you don't want to pay any taxes that could happen from selling the first home. You just do something called a 1031 exchange. You could basically take one property, exchange it for another one, and you don't pay any taxes. You now defer the taxes until you sell that house. Well, if you don't want to pay taxes when you sell that house, 1031 exchange it again. This is how people build housing wealth. They'll buy one house. They'll then 1031 exchange it to a duplex. They'll then 1031 exchange it to a triplex. They'll then 1031 exchange it to a quad. And then they'll 1031 exchange it to a 10 apartment condo. Perfectly legal, perfectly legit. That is definitely a way you can build housing wealth and scale it out over time. So these are all things like real estate can be almost like self-employed income. If you use TurboTax, they charge you extra for that. But these are the ways that you can use real estate as part of wealth building in a tax efficient manner to avoid taxes, defer taxes, and just build wealth in a more optimal way. Oh my goodness, we're gonna finish on time. I know that was a lot. So in summary, I mentioned this earlier. Tax time can be stressful, but it's a necessary time of year for pretty much all of us. By understanding your income, by increasing your knowledge around taxes, by just being aware of some of the abilities and some of the strategies, you can hopefully lean into your tax person, your advisor, your accountant, yourself, if you're doing the taxes, and just look for a little nugget here or there that can help you optimize your tax return to just reduce your income, increase your credits, and ultimately pay less in taxes and put more wealth back into your pocket. So that was the goal for today, to hopefully give you some knowledge, some tools, some secrets, some insights to maybe help you have a more successful tax season this year and for the rest of the tax years for the rest of your life. So that is all that I have for you today. As I said earlier, if you're a business owner, next month we're going to go much deeper into business owner tax situation and then things related to just the finances of being a business owner and planning opportunities. But that's all we have for today on the tax front. So I will take a look and see if there's any questions. Again, I'm open to questions, comments, concerns, complaints. All the C words are fine with me. So feel free to put it in the chat box. Bob, thanks for the question. We are now taking all of our recordings and putting them on our YouTube. We used to list them privately. We have clicked a button. They are all now public and available on YouTube. So you can actually go to YouTube and see it. If you need us to send you the link to the YouTube page, let us know. If you want us to just find the specific video, ask your advisor, and then your advisor or one of our team members will make sure that we get the recording to you. This specific recording, we'll probably get it updated tomorrow or Friday at the latest. But yeah, we're going to keep building out the YouTube library over and over and over to try to make it as robust as possible. If I take a distribution at 65 from my IRA, does any of that count towards my RMD when I turn 73? Great question. Kind of. So your required distribution is based off of the total amount of money in your account the last day of the year before you turn 73. So by taking money out at 65, it reduces the amount of money you'll have in the future. It doesn't actually get credited as a distribution, but it does at least make your total assets smaller by the time you're forced to take it out. So I guess the real answer is no. It doesn't count to reduce your RMD later, but it does reduce the pot of money, making the amount of the RMD lesser in the future. Great question, Heidi. How can we grow our FSA if we can only carry over $500 per year? You know, Troy, unfortunately, you cannot. You pretty much have to spend it down every year. And that's the main beef that I have with FSAs. Because with HSAs, you can grow it and grow it, grow it, and grow it. So yeah, unfortunately, the FSAs, if 500 bucks is the carryover, then that's all you can do. The only thing you could potentially do is spend it down, buying things, and then reselling them, and then investing the money. But unfortunately, FSAs are just, in my opinion, inferior for that reason. They're not built to let you build up assets over time. So yes, it's the Innovative Wealth Building YouTube channel. If you check it out, don't laugh. You know, it's still a baby, but we're going to build it out. We're going to put more content such as this on it. And then I'm sure we'll add even some of our shorter, more topical videos as well. Any other questions? While I wait for questions, I will end this the way that I always do. And that's just by saying thank you. I appreciate you taking the time. We appreciate you being interested in investing in the time to learn more about taxes and to spend this time with us. We know that the time you have is valuable. We appreciate the opportunity to chat with you and to serve you and your family. So if we can help further, please let us know. Like I said, we have lots of resources. So if you like taxes, give us a shout. If there are any other questions, please put them in the chat box. But otherwise, thank you so much for your time and your attention. I hope that you have a great day, and we'll see you next time.